Hey everyone, Adam Curran here with Curran Financial Partners and Retire Y'all Radio. Let me tell you why I don't like long-term care insurance. Understanding that people should have some sort of financial instrument or money set aside to protect themselves from this risk. The number one cause of bankruptcy in this country is getting sick. It's not the stock market or cryptocurrency or credit default swaps. It's getting sick. And it's typically not because you have a heart attack and you meet your maker after a big meal. It's because you have a debilitating illness that requires you to fork money over day in and month out in order for people to continue to care for you and in order for you to age with dignity. So long ago, there used to only be two options for us to address this risk. One was to buy long-term care insurance. Now, in my opinion, long-term care insurance is a tremendous ripoff. There used to be 40, 50 different carriers that offered this stuff. And because of the increasing risk that they were taking on, many of them just completely got out of the business. Now there's like 4 or 5. And because of the laws of capitalism, when there's less suppliers and there's more demand, there's going to be more higher and higher costs associated with it. So very, very rarely do we advise people to buy a old-fashioned long-term care insurance. Now, what's good about it is if you buy the insurance, say you buy it in your 50s or your 60s, your costs will be lower if you buy it in your 50s, but who wants to pay a insurance cost for the next 30, 40 years of your life potentially? But if you buy it, you immediately get pretty strong benefits. It's almost like auto insurance. The day you buy your auto insurance, you could get in a car wreck the next day and you're going to be covered. Same thing goes for long-term care insurance. Now, the problem with long-term care insurance, when you buy it, you're locked into that policy and the insurance company holds all of the cards. The insurance company reserves the right to increase your insurance or lower your benefits. The other dirty little secret about the insurance industry is all too often I meet with individuals who have long-term care insurance policies, utilizing the long-term care insurance policy, and the insurance company is fighting with them, saying that certain claims won't be covered due to the provisions within the policy. So the alternative to buying a prototypical long-term care insurance policy back in the day was you self-insured. Prototypically, when you get sick and you need to be confined to one of these facilities, the first thing they ask you is not what ails you, not how are you doing, it's how are you going to pay for this? So these care facilities are going to want a declaration of your assets. They're going to want a balance sheet. They're going to want to see how much your home is worth, what you have in your IRAs, what you have in your brokerage accounts. Because they are readily conscious of the fact that a lot of people who find themselves in care facilities will do what's called a Medicaid spend down. They'll burn through all their money, and then they find themselves on Medicaid. And due to the baby boom demographic aging and just the size of that demographic, I don't want to see anyone I work with on Medicaid. You are officially a ward of the state. All states have their own rules, but prototypically they let you keep your house, a car, a burial plot, a wedding ring, and about $2,000 in cash. And you are officially destitute, and you're now getting provided care from your state Medicaid program. So I don't want to see you fall into this trap, and I also don't want to see you buy prototypical long-term care insurance. The good news is there has been a ton of financial innovation right here in the middle. And these are what I call qualified healthcare riders. And these things were introduced via the Pension Protection Act of 2006, and there was about 2 of them back then. Fast forward till today, there's over 100 of them. And some of them have a higher emphasis on long-term care benefit. Some of them have a higher emphasis on self-insuring, meaning you make more interest with them. And these are financial instruments you should explore. From a high-level view, here's what they provide. The reason people like them, the reason I like them, is they have similarities to like an HSA, a health savings account, if you've ever utilized one of these. And what people love about health savings accounts is one of 3 things happen to us in this world. One, What if we die in a recliner after a big meal? That's what we all kind of hope for. Well, if we die, depending on which qualified healthcare rider you choose, all of the money in that plan, sometimes even more money than what you put in the plan, goes to your heirs, oftentimes plus interest. So you're not throwing money into an insurance wishing well like you are with prototypical long-term care insurance. Let's face it, you're putting money into a long-term care insurance policy, hoping you never even use the insurance. It's just like auto insurance. Who wants to get in an accident? So with these policies, any money you put into that qualified healthcare rider, chances are your heirs are going to get it back, maybe even more than what you put into it. Number two, most of the qualified healthcare riders that I use, let's just say you get dealt a terminal illness and you just want to throw a big old party, or you want to give all your money away, or let's say the stock market crashes and you want to take your money and go invest in real estate, or you want to take your money and go elsewhere. You want to get treated like a king or a queen in Mexico for 1/3 of the cost. Medical tourism is becoming a very real conversation being had in this country. If you ever want to take your money and run, the accounts will offer you an out. Oftentimes, you can take your money and run plus interest with some growth on your money. There might be early withdrawal penalties where they're going to slap you on the wrist if you try to leave early, but there's typically a provision within the account where you can take your money and run. This is not something that you have at your disposal with prototypical long-term care insurance. You can't say, hey, insurance company, give me all my premiums back. I don't want it anymore. With a qualified healthcare rider, you have that option. Lastly, the reason you would set up a qualified healthcare rider, if you need long-term care, if you can't do 2 of your 6 activities of daily living, a feature on the account kicks in and it'll double your account value, or it'll double your income benefit that you can utilize to help pay the cost that comes with needing extensive medical care. Lots of different ways you can structure them. As I said earlier, some of them have a higher emphasis on give me the maximum amount of long-term care possible. Some of them have an emphasis on show me how I could grow my money. Show me how this could almost be like a bond alternative. Show me how this could be a component of my portfolio to grow money securely, but here in the same time offers a long-term care benefit. These are accounts we've seen a tremendous amount of innovation, and I strongly consider you looking into them. I wrote 2 books, and in both books, there is a chapter on this very subject. We talk about qualified healthcare riders. We talk in greater depth about how you might utilize them within your portfolio. Lean into my office, call us up, request the books, subscribe, share, do all the things. Thanks for tuning in.